afternoon, everybody. Welcome to the presentation of our first impact report. I think this will be the first of many. So first question, of course, why are we writing the report? I think it's because impact is taking the financial market and the tech world by storm. It's impacting us as well, like all of you on the call today. I think, from a GP Bullhound perspective, I think our investment policy, our client choosing policy, all of that is impacting by the wave that's unfolding now. The questions we get from our prospects, from our friends, from you on the webinar about what we're doing to facilitate sustainability, to facilitate climate change and climate transition. So it's very top of mind for all of us. And I think basically it's triggered, our view is that, of course, it's been triggered by the increasing climate and social urgency in our world, but also to a degree triggered by tech, which has allowed basically to produce data and to produce solutions to that, to answer to that urgency, as Manon will develop later. So Franze, if you want to go to the first slide of the quick deck I will present. So first of all, I was talking about urgency, and I think this chart basically maps out the increasing degrees of the temperature on Earth compared to the average of 1950, 1980, which is which the yardstick people typically look at. Today we're at a little bit over 1 degree above that average. And what's interesting is that I think what really pushed this idea of climate urgency and this is the Brundtland report, Our Common Future report in 1987. And this is considered by many as the watershed moment when suddenly, the notion that our human activity, human progress, economic progress is actually seriously impacting the environment. That really became mainstream for political spheres, for economic spheres and regulatory. And what's interesting is that since then, if anything, global warming and CO2 emissions have continued to increase at a faster rate. And then, you can see some key moments of the increasing consciousness and decision process of the world trying to fight those CO2 emissions and, to create what we call the climate transition towards a sustainable planet. And yet, despite that, it continues to average degrees and CO2 emissions have continued to grow. So minus 30 is basically by how much we need to reduce carbon emissions in 10 years if we want to stick to the Paris goal of limiting global warming to substantially below 2 degrees. What's interesting is that means about 3% per annum from now to 2030. At the time, at Paris Agreement, it would have been 1.5 or 1.3% per year. But since then, time has reduced and CO2 emissions have continued to increase. And it's not just it's not just the environment. It's also social. And there, I think one example, one illustration is that since 1990, the top, the wealth owned by the top, accumulated by the top 1% in the US has gone from 23% to 31%. So there also, you can imagine the effect it has on the social, consequences in the US, but this is across the world. So there is urgency on both sides. It's not just the environment. So from that, I think that's a statement that everybody would agree to now. What are the pressure points to really push the capital reallocation that we are really starting to witness now? So Franze, if you can move to the following page, please. So, several factors, but essentially, finance reacts to pressure. So consumers want it. One example is if you look at packaged goods in the US with a sustainability claim versus conventional, the market increase has been 5-fold since 2013, and it's if anything, it's accelerating now. Savers want it. They are top of the finance pyramid, savings. Um, Same thing. If you look at the new generations, the future squirrels, the Henrys, 90% of them in the US say that they are interested in actually pursuing sustainable investment in their investment pocket there for 1Ks over there. And then it works. I think we've done some rough estimate. I mean, it's the first report, so bear with us, but I think Manon will detail that. We've run some analysis on thousands of listed companies, private placements, and we think we can find a 10 to 30% premium on EV to last 12 months revenues for companies with an impact color versus their sector. More of that later, and again, analysis to be refined over time. Governments and institutions are pushing for that. I think Biden, I think it was his 9th executive act, was actually to enact, social and carbon cost, and also to force non-financial sustainability disclosures within a year. The same can be said about the EU. And finally, corporates now are, of course, acquiring assets which can help them accelerate their own climate transition and sustainability, social sustainability transition. We've seen an increase between 19 and 20 of 30% in M&A deal value for ESG and impact transactions or on such targets, which is more than the market at large, which has been at best stable depending on the spaces, on the sectors. Now let's see what it means in terms of this wave of capital relocation, which we've tried to size. Next page, please, Franze. So number one, ESG, environmental, social, and government. So this, we think it's basically gone mainstream. If you look on the left graph, you will find that now an estimated 42 trillions of assets under management follow the ESG principles, or let's say they are the ESG compatible assets from UN PRI signatory, UN principles of responsible investments. So this is like almost 40%. It's probably past the 40% mark in 2020. We don't really have the data, so it's made it to mainstream, I would say, and it's still growing around 15%, which is of course faster than the assets managed by professional managers worldwide. And then in parallel, we think it's become, to deserve the ESG, the ESG label has become more stringent. I think in the 1990s, this was all. The essential idea was about basic damage control. Just check that there is no catastrophe looming within the company, in terms of HR or pollution. And then it's moved towards some key OPEX functions, just making sure that you can optimize your workforce and optimize your energy consumption by such criteria. And then it's become, let's look at the core company organization. And now I think this is what we're seeing now is basically reinventing the activity so that it's more ESG performing. Okay, so it's mainstream and it's moving towards more stringent criteria. But then the more interesting one is what's happening now, which is the next page, if you don't mind, Franze, which is impact funds. So impact funds, I would say, as opposed to ESG, where we said, if we compare the two, we define, and I think many in the industry define ESG as really a focus on the internal processes, governance, and operations of the company. So whatever their core activity, do they optimize for good behavior in terms of climate impact and social responsibility and behavior? Whereas impact is investments in companies whose core business or core products actively contribute to the sustainability, to the climate transition, as well, of course, as meet minimum ESG requirements. So it's a subpart, and it's quite a small subpart for now. I mean, the estimates we could find was that you're a little bit below 1 trillion, which is like not even 1% of the AUM. If you remember, we're talking about nearly 40% of global asset under management in ESG, less than 1% for impact. But I will say ESG is currently growing. ESG investing is growing at around 15% per annum, whereas we're above 70, nearly 80% per annum for impact. And we think, of course, this is just the beginning. 3 reasons I would highlight among many. I mean, number one, there is more formal disclosure rules coming in the EU, coming in China, coming in the US with the Biden administration, which means that many de facto impact investors who haven't really declared or disclosed their impact investment criteria will come out and will add. So there is already more probably than what the chart shows. Secondly, ESG, which we've said is becoming more stringent and more, the criteria are becoming probably more stringent. Despite that, many people do believe that it is a little bit of a box-ticking exercise. And so this is pushing towards impact. And typically, regulators and consumers are also pushing for impact and climate transitions. So, all in all, as you can see, this is the middle of the wave for ESG, the start of the wave for impact, but this will be the really interesting one. There is much more in the report. I engage you to read it, but these were just a few headlines which I wanted to share at this stage. And I will turn to Manon to detail a little bit what it all means for the tech ecosystem. Manon, over to you. Thank you.
Yeah, thank you, Guillaume. Franza, can you go to the next slide, please? Yeah, perfect. So we discussed how the sustainability urgency has hit the financial industry, and it is also hitting the tech industry today. So for a long period of time, the tech ecosystem was more or less spared by scrutiny compared to other sectors such as oil and gas that has been under scrutiny for decades now. But recently, the confidence has started to decrease, and we have seen a range of controversy recently. So we have, for example, an increasing amount of controversies around negative environmental impacts of tech with streaming, data flows, cloud pollution. So, and as you can see on the slide, the CO2 emissions from the digital technologies are growing, have been growing 9% per year, whereas it's 1% for global emissions. So the environmental impact is increasing and increasingly recognized. You also have a range of controversies in politics, so the role of social networks with the capital riots, the overuse of the gig status by some platform companies, such as ride-sharing companies or food delivery companies. And just this week in the UK, for example, Uber has announced that the status of their driver would be from freelancers to workers. And that follows court decision from the UK government. So with all that, you have an increasing number of controversies and spotlight on the tech industry. What happened in France quite recently is also interesting with the 5G. So you had, for the first time, citizens, politicians as well, weighting the usefulness of a tech, 5G, against its potential negative and social impacts. And the balance between the two, is resulting in effective action. For the 5G, it was pausing for a few months the deployment of 5G in France. So that's what was the debate. And we believe it's this kind of weighting between economic impact and environmental and social impact is going to increase in the coming years. And actually, the tech ecosystem, so as I said at the very beginning, is a bit late on that. For example, Amazon, Facebook have only launched their first CSR report in 2019, which is quite late given their weight and their power on society. And we also can see in the VC ecosystem, everyone speaks a lot about tech for good, but not that much about negative impact and responsibility. And somehow it's quite logical because, well, the whole tech industry and ecosystem has been built by founders with vision for the future, and as well this tech industry is growing really powerful in very short amount of time. We're speaking about a few decades. So that's an ecosystem that somehow was built on the idea that everything was possible and that they would change the world. And now this really powerful ecosystem is facing boundaries like all the other sectors, but it's facing social and environmental boundaries. So it's kind of a shift in the paradigm and the vision that the ecosystem is giving. But that being said, this ecosystem has strong potential for quick catch-up. As we all know, when tech entrepreneurs and when the tech ecosystem at large start to tackle some challenges, it blasts it away. So when the tech ecosystem becomes serious about sustainability, then the changes we can expect will be quick and massive. And actually that has already started. 2020 was kind of a record year. With that, we had, for example, Amazon that launched a 2 billion fund for clean companies. We had also Google issuing a 5 billion CSR bonds, which was the first for the sector, and Microsoft as well committing more than 1 billion in carbon storage innovation. These are the tech giants, but you also have a range of other companies that are going fast as well, that are moving into sustainability policies. I'm thinking about Zalando. They announced last year that in 2023, they would only accept in their platform sustainable brands. And also Klarna, a few weeks ago, they just announced that 1% of their last fundraise would be dedicated to investing in sustainability. So we believe these are good signs that the ecosystem is starting to move, and that we believe that will drive, and that has already started to drive significant capital flows from investments, acquisitions of sustainable assets. So if we can move to the next slide. Yeah, thank you very much. So in our report, we wanted to highlight some tech impact subsectors we believe will be instrumental for the climate and sustainable transition and are likely to really benefit from the increased attractivity of sustainable assets. So there are lots of things happening, especially in resource efficient production and consumption. You have a bunch of interesting companies in urban farming, plant-based meat solutions, artificial meat, insect farming, and that's moving really fast with mega rounds this year and the past few years. Also on the consumption side, you have a lot of things moving fast. You have the smart mobility, which is thriving. You also have circular economy and sharing economy. Now, the circular economy is really interesting because we had the opportunity to speak with entrepreneurs this past weeks on sustainability, and lots of them agreed on the fact that at the moment, second-hand, for example, is booming, or refurbishment is booming, and that's partly driven by sustainability and consumers willing to consume more sustainably. We also have lots of interesting innovation in data analytics. So we'll see just after during the panel discussion what Ravenpack or the Ecovedis are doing in terms of ESG analytics and how you can have very innovative solutions to get more transparency through AI and through data analytics and structuring. So we focused our analysis on tech impact sectors, but so you have a range of impact sectors that directly contribute to the transition, but you also have many companies that are in switch sectors. And so, for example, if you take fintech, depending on your policy, you can be, well, either have sustainability practices and have a good impact or you can have a negative impact. For example, Aspiration, it's a US digital bank. I'm sure you all know it. And they have committed to invest all the savings of their clients to ESG assets. So they are having really positive impact. They are backed by impact funds. But at the other end, if you are digital bank and you don't have any policy around the investment, then you could be investing in oil and gas, and obviously that's a negative impact. So in the coming slides, we capture funding and M&A for all the companies we considered impact sectors in this impact sectors and impact companies, and we based on analysis on sustainable development goals and on the European Union green goals. So if we go to the next slide. Yes, so as we said, the funding of impact companies is increasing really fast. So 2020 was a bit of a record year, and we had a bunch of mega rounds with EcoVadis, Back Market, Coursera, OneTrust, raising more than 100 million. Something interesting to note is that they raised funds with impact investors, but as well as with generalist investors. So we think there is a bit of a competition for sustainable assets. Of course, all the funds with impact and ESG have this, I would say, advantage for entrepreneurs that are really keen on having an impact investor with them. But actually, all the funds are interested in sustainable assets, which creates a lot of competition and we believe creates value. So if we go to the next slide. So in terms of M&A for impact companies as well, 2020 was a bit of a record year. So, well, 36 billion of the 69 are due to 4 transactions. So if you take them out, you're a bit lower, but it's still increasing a lot. And so for M&A, we had different types of transactions. We had transactions that are consolidation within impact sectors, for example, with the transaction of Livongo and Teladoc, but you also had some traditional players buying sustainable assets, for example, Morningstar, that increased its stake in Sustainalytics. In terms of, so we believe this generates a valuation premium, and if we go to the next slide, and yeah, thank you. So we estimated that the valuation premium is between 10% and 30%. We analyzed for that more than 1,000 transactions, and that's the figures we find. So that's quite clear that there is at the moment premium for being a sustainable asset or for developing sustainable practices. And that's what we wanted to emphasize. And well, I encourage you to read more into the report to get more detail on that. So I'll send over to you again.
Thank you very much, Guillaume and Manon.